Should I pay down debt or invest? This is a classic question that people ask regarding their money. In this video, I will give the simple rule of thumb. Then we'll consider other factors to better answer this question. And I will end with a few case studies of real-life examples and numbers. Before I talk about the rule of thumb, let's first compare apples to apples. Paying down debt is an investment. When you pay down your debt, you no longer pay interest on that debt. That interest savings is the return on the money invested. For example, if you have a mortgage that charges 3% interest and you pay down extra $100 of debt, you will save roughly $3 of interest over the next year. That is a 3% guaranteed return. Now we can directly compare debt pay down and investing. Continue the example above. Suppose you can invest in the broad equity market and make 8% on average. You now have the choice of paying down debt to earn 3% guaranteed return and investing to earn 8% on average. You should choose to invest for higher returns. The simple rule of thumb is to choose whatever is giving you the best return on debt payment or return on investment. Now suppose you have another choice by adding a credit card debt that charges 18% interest. You should definitely pay down the credit card debt because now the credit card debt paid down is an 18% guaranteed return, higher than the 8% return from investment and 3% from mortgage payment. Putting money towards the higher returning option is not always optimal. You need to consider other factors. How important is it for you to be debt-free? If your financial goal is to be debt-free, then the choice is easy. Pay off the debt first. How bad is missing a debt payment? If missing a mortgage payment and losing your home keep you up at night, you should set aside an emergency fund. The ability to avoid debt default is often more important than making the highest return on investment. If you put the extra money into debt paydown, it's difficult to access the money quickly. Or if you put the extra money into investment, you run the risk of needing access during market downturns or buy high, sell low. So having an emergency fund can help you avoid debt default. How high is your risk tolerance? Risk tolerance is your ability and willingness to withstand volatility or downturns in your investment. If losing 10% of your home value or 20% of your stock value makes you sick to the stomach, then you have a lower risk tolerance. If you get excited over a 30% market drop like I do, then you have a high risk tolerance. Those with high risk tolerance tend to have high income, long time horizon, and deep investment experience. If you can't stomach risk, then you would prefer stable investments, even if they return less. For example, you would pay off a 7% loan for guaranteed savings instead of expecting 8% average return from a volatile stock market. When having a low debt-to-income ratio is important. When you need to borrow more money in the future, you want to keep your debt-to-income ratio low. You should first pay off short-term debt with smaller balance, like auto loan, relative to long-term debt with larger balance, like your mortgage. Because smaller balance can be paid off faster and your debt-to-income ratio improves more quickly. Paying off part of a larger loan doesn't change your monthly payment. When the investment environment is too volatile or too expensive. If you are confident that it is a bad time to invest because you expect volatility or market downturns, then you should hold on to your money. In this case, liquidity in the form of cash is important. The 8% number I used in the example above is an average. The return in any given year can be higher or lower than that. You have to make your own judgment on forward-looking returns, or you can just watch my prediction videos. You need to think about taxes too. When you pay down debt, you lose tax deductions on some types of interest, so your after-tax interest savings is lower. You pay taxes on investment gains, so your after-tax investment returns are lower too. But long-term capital gain tax rates are usually lower than ordinary income tax rates, so the tax effects on investment returns are marginally more favorable than the tax effects on interest savings. For example, a married couple who files taxes jointly makes $100,000 a year. Their long-term capital gain tax rate is 15%, and their marginal federal income tax rate is 22%. For this couple, after giving up tax deductions by paying down a 3% interest rate mortgage loan, they make a 2.3% return. After paying taxes on long-term capital gains, they make 6.8% instead of 8%. With all those said, let me give a few real-life case studies. Case study number 1. You're 25 with little to no savings and a high risk tolerance. You have 100% 401k employer match, up to 6% of your salary. $40,000 student loan at 6% interest. expected investment return of 8%. Then you should take advantage of the 401k match first, because that's a 100% return instantly when your employer matches your contribution. At the same time, build up 6 months savings to give you a safety cushion. If you don't need to withdraw the investment money before retirement, then max out the 401k contribution above the 6% match. Then balance between paying down the 6% student loan and contribute to a taxable investment account with 8% expected return. The after-tax return of the investment account might be similar to the 6% savings from student loan. Case study number 2. You are 35 with some savings and moderate risk tolerance. You have $10,000 credit card debt at 18% interest rate, $10,000 student loan at 7% interest rate, $200,000 mortgage loan at 3% interest rate, and expected investment return of 8%. Then you should prioritize paying down the 18% interest rate credit card debt. Once your high interest credit card debt is paid off, then you should focus on paying off the 7% student loan, even if the 7% savings is less than the 8% expected return from the stock market. After considering your risk tolerance and being relatively young with a long time to invest, you're better off paying off the low balance of $10,000 student loan at 7% savings. After that, you should then keep the mortgage loan and not prepay more than needed, and invest your extra cash flows into investing. Case study number 3. You're 45 with high income with 35% income tax rate and 20% capital gain tax rate, and deep investment experience. You have loans with tax deductible interest at 12% interest rate, 12% expected return in investing. When you pay down debt, you save 12% interest minus the 35% of tax deduction on the interest, so actually about 7.8% return. When you invest and make 12% long-term capital gain, after paying 20% capital gain tax, your return is 9.6%. Then you should definitely invest at 9.6% after-tax return over paying off debt at 7.8% return. So my rule of thumb is to put money into the most productive choice. That means prioritize saving 18% credit card interest over earning 8% investment return over saving 3% mortgage interest. But if you don't want to risk missing a debt payment, put the money in emergency fund first. If you have the guts for risks, then take some calculated risks. If investment environment is unfavorable, wait. Lastly, factor taxes into your returns. I hope this is helpful to you. Please like and comment on this video. Please subscribe to my channel for future uploads. As always, thank you for being here, and I'll see you soon.